Welcome back to the channel. Today we're diving into the recent bloodbath in the crypto market. I know a lot of you are feeling the pain and you're probably wondering, what the heck happened? Trust me, you're not alone. Over the past few weeks we've seen Bitcoin tumble, Ethereum take a nosedive, and the altcoin market go absolutely haywire. It's been a wild ride and unfortunately it doesn't look like it's over yet. But don't worry, in this video we're going to break down the top 5 reasons behind this crash, step by step, so you can understand exactly what's going on and how to navigate this market turmoil. Let's get into it.
So the first thing we need to talk about is the overall economic climate. Right now, things are looking pretty shaky. We've got rising inflation, interest rates are going up, and there's a lot of talk about a potential recession looming on the horizon. And it's not just the US economy that's looking a little green around the gills. We've got geopolitical tensions flaring up all over the place, from Europe to Asia. This kind of global uncertainty makes investors really nervous, and when investors get nervous, they tend to pull back from riskier assets. And guess what's considered a risky asset? You got it. Cryptocurrency. So, as investors get spooked by the state of the world, they're pulling their money out of crypto and into more stable assets like gold or good old-fashioned cash. To make matters worse, the latest US employment figures came in way below expectations. This is a big deal because it suggests that the economy might be slowing down even faster than economists had predicted. And when the economy slows down, people tend to spend less money, which can lead to even more economic instability. It's a vicious cycle, and unfortunately, crypto is caught right in the middle of it. Remember, the crypto market is still relatively young and easily influenced by macroeconomic factors. When the global economy sneezes, crypto catches a cold. And right now, it feels like the global economy is coming down with a nasty case of the flu. So, what does this all mean for you? Well, it means that we need to be extra cautious right now. This is not the time to be going all in on risky investments. Instead, focus on preserving your capital and weathering the storm. This economic uncertainty isn't going to last forever, and when the dust settles, there will be plenty of opportunities to buy back into the crypto market at a discount. But for now, it's all about playing it safe and riding out the wave.
Now, let's talk about something a little more specific to the crypto world, the Mt. Gox Bitcoin distribution. If you're not familiar with Mt. Gox, it was a cryptocurrency exchange based in Japan that went bankrupt back in 2014 after losing a whopping 850,000 bitcoins. Fast forward to today, and after years of legal battles, the remaining Bitcoin from Mt. Gox is finally being distributed back to creditors. This is a huge deal because it's injecting a massive amount of Bitcoin back into the market, which can have a significant impact on the price. Think about it. If you were a creditor who just received a bunch of Bitcoin that you thought was lost forever, what would you do? You'd probably sell some, right? Well, that's exactly what a lot of Mt. Gox creditors are doing, and it's putting downward pressure on the price of Bitcoin. Now, some people argue that this sell-off is just temporary, and that the market will eventually absorb these newly released Bitcoins, but others are concerned that it could lead to a prolonged bear market. Only time will tell who's right, but it's definitely something to keep an eye on. Imagine waiting almost a decade to finally get your money back, only to see its value plummet as soon as you receive it. It's a tough situation for these creditors, and it highlights the inherent volatility of the crypto market. This Mt. Gox situation is a stark reminder that even in the world of decentralized finance, centralized entities can still have a massive impact on the market. It's a complex issue with no easy answers, but it's definitely something that every crypto investor should be aware of.
Moving on, let's talk about another factor that's been weighing on the crypto market: regulatory delays. Specifically, the delay in the listing of spot Ethereum ETFs, despite their recent approval by the US Securities and Exchange Commission, SEC. Now, for those of you who aren't familiar with ETFs, they're basically a type of investment fund that trades on stock exchanges, much like individual stocks. They offer investors a way to gain exposure to a basket of assets, like stocks, bonds, or in this case, cryptocurrencies, without having to buy and hold the underlying assets directly. The approval of a spot Ethereum ETF was seen as a major win for the crypto industry because it would have made it easier for institutional investors to get involved in the market. However, the SEC has been dragging its feet on actually listing these ETFs, which has created a lot of uncertainty and frustration among investors. This delay is a clear indication that regulators are still trying to figure out how to best oversee the crypto market, and it's likely to be a while before we see any major breakthroughs on this front. In the meantime, this regulatory uncertainty is likely to continue to weigh on the market, as investors remain hesitant to jump in until they have a clearer understanding of the rules of the game. Think of it like this. Imagine you're trying to play a game of basketball, but the referees keep changing the rules in the middle of the game. It would be pretty frustrating, right? That's kind of what it's like for crypto investors right now. The SEC is like the referee, and they're constantly changing the rules, which makes it difficult for investors to make informed decisions. This regulatory uncertainty is a major roadblock for the crypto industry, and it's something that needs to be addressed if we want to see widespread adoption of cryptocurrencies.
Now let's shift our focus to the macroeconomic stage and talk about the US dollar. You see, the dollar isn't just the currency we use to buy our lattes and avocado toast. It's also the world's reserve currency. This means that it's used for international transactions, and central banks around the world hold it in their reserves. And guess what? The US dollar has been on a tear lately, reaching its highest level in over 2 decades. Why does this matter for crypto? Well, when the dollar strengthens, it tends to put downward pressure on riskier assets like cryptocurrencies. Think of it like this. When investors are feeling uncertain about the global economy, they flock to safe haven assets like the US dollar. This increased demand for dollars drives up its value, making other assets, like crypto, relatively less attractive. So, as long as the dollar remains strong, it's likely to continue to act as a headwind for the crypto market. It's like a seesaw. When one side goes up, the other side goes down. Right now, the US dollar is on the upswing, which means that crypto is feeling the downward pressure. This inverse relationship between the dollar and crypto is something that investors need to be aware of, especially during times of economic uncertainty.
Finally, let's talk about leverage and liquidations. Now, leverage is basically a fancy way of saying borrowing money to invest. It's like putting your crypto on steroids. It can amplify your gains, but it can also magnify your losses. And in a market downturn like the one we're experiencing now, leverage can be a recipe for disaster. Here's how it works. When you use leverage to buy crypto, you're essentially borrowing money from the exchange to increase the size of your position. If the price of crypto goes up, you make a profit on your initial investment plus the borrowed funds. But if the price goes down, you lose money on both your initial investment and the borrowed funds. And if the price drops far enough, you can get liquidated. Liquidation is basically when the exchange forcibly closes your position to cover their losses. This usually happens when the value of your collateral, the crypto you put up as security for the loan, falls below a certain threshold. And when a lot of leveraged positions get liquidated at the same time, it can create a cascade of selling that drives the price of crypto down even further. It's like a domino effect. One liquidation triggers another, and before you know it, the entire market is in freefall. This is exactly what we've been seeing over the past few weeks, as the initial price decline triggered a wave of liquidations that exacerbated the downturn. The high levels of leverage in the crypto market are a major concern, and it's one of the reasons why this crash has been so severe.
And there you have it, folks. Those are the 5 primary reasons behind the recent crypto market crash. We've got economic uncertainty, the Mt. Gox Bitcoin distribution, regulatory delays, a strong US dollar, and leverage and liquidations. A perfect storm that sent shockwaves through the crypto world. Now, I know this is a lot to digest, and it's easy to feel overwhelmed by all the negativity. But remember, the crypto market is cyclical. It's gone through booms and busts before, and it will go through them again. The key is to stay informed, manage your risk, and not panic sell. If you believe in the long-term potential of crypto, then this too shall pass.